Okay, ladies and gentlemen, it is time to get started. Welcome to the Option Industry Council webinar series. My name is Mark Benzequin, and I am going to be your host today for the cash secured put, one of my favorite trading strategies and definitely one of the more popular in the options space. Before we get started, our typical disclaimer: options involve risks and are not suitable for everyone. For those of you joining us for the first time, or those of you that are new to trading, you'll want to contact your broker or contact us here at OIC to obtain a copy of the Characteristics and Risks of Standardized Options booklet. You can download a copy on our website, or as I mentioned, contact your broker for a physical copy. We're going to be keeping things simple today. The calculations that we're going to be using in these examples, we're not going to be talking about some of the different financial impacts to your trade, such as commissions, fees, taxes, etc. And again, of course, any strategies that we're discussing today are simply for educational purposes. Speaking of education, that is what OIC is all about. We are a free and unbiased professional organization dedicated to teaching investors, individual investors, financial advisors, really the financial space as a whole, the benefits and risks of trading exchange-listed options. The majority of our resources are offered on our website, optionseducation.org, where we offer online courses, podcasts, videos, and webinars. And the pride of OIC, that being our investor education or our investor services team, a team of dedicated options professionals collectively with close to 100 years of experience in the business. And we answer your questions via email or live chat. Our email address there on the screen, options@theocc.com. Speaking of your questions, we do have two of OIC's favorites waiting in the wings in the background. We've got Ed Magla and Ken Keating taking your questions as they come in. So feel free to submit your questions via the Q&A box to the left of your screen, and they will be responding to those questions in real time. As to OIC, the fact that we do offer free services, that's possible because we are fully supported and funded by OCC, the Options Clearing Corporation. And just a side note here for OCC, the OCC is very sad to hear of the passing of one of OCC's founders, Mr. Wayne Lutheringhausen. And Wayne was the original president and CEO of OCC back when it was formed in the early 70s. Wayne also was key in creating the OIC, the Options Industry Council, back in 1992. So Wayne and his family, we want to express our deepest condolences and our thanks for his involvement in the options industry. Now, when it comes to the, I apologize, I'm trying to find the right screen here. When it comes to the cash secured put, our presentation is simply going to be first and foremost covering the basics, what puts are, why we use them, the motivations and objectives of trading puts, and particularly selling puts. Then we're going to go into some of the more common questions that we receive here at the OIC, choosing your strike, choosing the expiration. We'll go through an example of a cash secured put, and then talk about some of the different risks of trading cash secured puts, such as the potential early assignment, and other risks associated with the strategy, as well as position management, what to do when things go wrong. And then we're going to finish everything up with some Q&A. So put basics, what are they? Well, a put holder, the buyer of a put, has the right to sell stock at the strike price anytime before that contract expires. And the seller of the put has the obligation to deliver those shares. So if a put buyer purchases a $100 strike put, that buyer has the right to sell 100 shares of stock at $100 a share. The put writer, the seller of that contract, is now obligated to purchase those shares should they be assigned. Here's another look, and for those of you that have downloaded the slides, this is something that you'll want to keep track of or bookmark, the difference between the put holder or the buyer and the put seller or the writer. The put holder, the buyer of a put, has the right to sell shares. The put seller has the obligation to buy those shares. The put holder exercises their right to sell those shares by exercising their contract, whereas the put seller, they fulfill that obligation when they receive that assignment notice. For those rights and obligations, the buyer and seller pay or receive a premium. The buyer pays the cost of the contract, the options contract, whereas the seller receives that cost. The outlook for a put buyer is typically bearish, meaning that they think that the stock is going to go down. However, there are other strategies where somebody might buy a put. It's called a protective put, where it actually is protecting the shares you own. You're bullish on the stock, but just in case things go south on you, you've got some downside protection. The put writer is typically neutral to bullish, meaning that they don't think that there's going to be a lot of market movement one way or another, or they think that the market is going to be increasing. So those are the basics of the puts. Again, just a little refresher for some of you that may be new to trading puts. And this is what the profit and loss diagram looks like. For those of you that are new to options trading, the profit and loss diagram is going to be a big help when it comes to understanding or forecasting what the profit and loss might look like at any given point. Let me pull out our pointer, and let's see, here we go. So with our profit and loss diagram, we've got our break-even point, and that break-even point is going to be the difference between the strike price. We've got, in this case, a $50 strike, and the premium that we receive is going to be $2.50. And I apologize, I'm having some pointer issues here. $2.50 is going to be the premium that we receive when we sell that put, gives us a break-even point of $47.50. So you can see if share prices finish above $47.50, we're going to have a profit. That profit will be maxed out at $2.50, which is the premium that we receive when we sold the contract. Anything below that break-even point, that's where we're going to lose money. And when it comes to selling puts, if you are assigned, you are going to be obligated to buy stock at the strike price. Theoretically, the stock can go to zero. So you do have substantial downside loss. In this particular example with the $50 strike, your downside loss is going to be $50 a share or $5,000. That's going to be slightly offset by the premium that we collected, and our maximum risk is really going to be that break-even point, $47.50 per share or $4,750. Now, the net stock purchase price. So looking back to that earlier example, if we bought, or I should say, if we sold the 50 strike put, we are theoretically buying stock for $50 a share. If we get assigned, we would buy 100 shares of stock at that strike price. However, because we collected this $2.50 premium, we're actually buying shares, we're theoretically buying shares at $47.50. So that's going to be the net stock purchase price. It's going to be the difference between the strike and that premium received. And since the risk in selling that puts, as I had mentioned, is that you would have to buy the shares at the strike price, and because the stock can theoretically go down to zero, upon execution of the trade, your brokerage firm or your trading firm is going to require you to deposit the strike price minus the premium to cover that potential assignment. That is the cash secured part of the put. When we sell puts, we're obligated to buy stock. We deposit the cash, the potential obligation in our trading account to cover that assignment, to cover that potential assignment. So that's where the phrase cash secured put comes from. Our obligation is secured by the cash that we have in our account. So why would people sell puts? And this is something interesting. Some of the questions that would be asked if you were to look at selling puts: do you forecast a temporary downturn in the market? Are you neutral to bullish on the stock? Are you looking to generate income, et cetera? What it really boils down to is, do you want to buy the potential dip? I'm sure a lot of people have heard the phrase in the market, buy the dip, or something similar. What the dip is, it's simply a temporary downturn in the market. If stock is trading 50, we might forecast that stock might trade downward to 47 or 46 before it goes back up to 50 or even higher. That's the dip. The dip would be between $50 and, say, $46. And the idea with selling puts is that you're looking to buy the stock for $46. It might be trading $50 in the market, and if you like it at 50, you're going to love it at 46. So you may want to put in place a strategy that hopefully potentially gives you the obligation, or may give you the possibility of purchasing that stock for $46, which is below where it's trading currently. So the idea of selling cash secured puts is simply to give you the opportunity to buy stock below the market. Now, when it comes to that, buying stock below the market, what price are we looking for? That's going to determine what our strike price is going to be. Again, where do you want to own the stock? The idea that I like it at 100, but I love it at 95, that's going to determine at which strike you decide to sell. Now, you can sell in the money, at the money, out of the money. There's differences between them. There's pros and cons of each. Certainly, if you sell an at-the-money put, you're going to be collecting more premium. The higher the strike in relation to the stock when it comes to a put, the more expensive it's going to be. So if you sell an at-the-money put, you're going to be collecting more premium up front versus an out-of-the-money put, let's say. So that's a good thing for a put seller. If the stock does slide a little bit lower and you sold an at-the-money put, likely you're going to be obligated to buy those shares. If the shares continue to slide, you may be buying stock above where it is trading at the time. So in at-the-money put, you may be collecting more money up front, but maybe you have more greater risk of assignment. In out-of-the-money put, you may be collecting less money up front, but there's less likelihood of assignment, or maybe there's a greater likelihood of that put simply expiring worthless, and you keep the premium that you received as profit. So there's certainly going to be pros and cons of each. And it's important when selecting that strike to be aware of what all of those benefits and risks are in terms of your strike selection. Strike selection is also important in terms of your required capital. Remember that we had said that when you sell your put, your trading firm is going to require that you deposit the difference between your strike price and the premium you receive to cover your risk. So let's talk about a $100 stock. If we sell a $100 put against it for, say, $3, our trading firm is going to require us to deposit $9,700, the difference between the strike price and the premium we received. They would require us to deposit $9,700 in our account to cover that potential risk. If we sold a 95 strike put rather than the 100 strike put, and maybe we collected 50 cents for that put, now our trading firm would only require $9,450 to be deposited. So we've got less risk by selling an out-of-the-money put in that sense versus the at-the-money put. So just another thing to think about when choosing the strike selection. But really the main feature or the main process when it comes to strike selection is simply this. Regardless if we're talking puts or calls, buying or selling, what have you, there's two questions that every investor should really ask themselves before engaging into a trade. Question number one is, where do I think the stock is going to go? Is it going to go up? Is it going to go down? Is it going to go up by $2 or $10, 5%, 20%, what have you? So where is the stock going to go? That determines what strike you're selecting with whatever strategy, with whichever strategy you decide to engage in. So where do you think the stock is going to go? Question number one. Question number two is, how long do I think it's going to take to get there? And that comes into play when we talk about selecting an expiration date. When, in this particular case with the cash secured put, when are those shares going to dip? If we think that over the next 6 weeks, the shares will decrease by, say, 5%, doing a 4-week trade doesn't really make a lot of sense. So we want to make sure that we're giving ourselves enough time. And again, this goes for any strategy that we're talking about, whether it's buying or selling, calls or puts, what have you. We want to make sure that we're putting ourselves in the best possible position for this trade to be successful, for this trade to be profitable. So when do we think the shares are going to dip? That is going to help determine when you choose your strike, or I should say when you choose your expiration. Are we looking long-term versus short-term? When it comes to that premium that we collect, long-term options are going to generate a larger premium versus short-term options. And it makes sense when we think about it from the seller's perspective. If I were to ask you where the share price of XYZ is going to be by the end of day trading tomorrow, you could probably be fairly accurate, maybe within a few percentage points, or maybe within a quarter or a dollar or something like that, certainly depending on the stock. If I asked you where that stock is going to be 2 years from now, I think you'd likely need a crystal ball in order to give me an accurate reading on that. So the idea being is the further in time we go out, the more risky it's going to be for the option seller, and therefore the sellers are going to demand a higher premium to account for that longer-term risk that they are obligating themselves to when it comes to a long-term option. So in terms of premium, you're going to make more in the long run, or I should say you're going to collect more with a long-term option versus short-term. So another thing to consider when selecting your expiration date. Also, time decay. For those of you that are new to options, there's a concept that's similar to a brand new car. When you drive it off the dealer lot, your option contract is going to begin losing value as soon as that trade gets executed. There is a pricing concept called the Greeks. And for those of you that aren't familiar with the Greeks, we just launched a new online course on our website about options pricing. The 4th module in it is an introduction to the Greeks, where we talk about this concept of time decay and theta, which is the Greek that measures the impact that time has on an option. And the reason that's important is because in the short term, your option value will decay by a significant rate, or significantly greater than it will over the long term. If we have 2 days to go before an option expires, the value of that contract is going to decay rapidly to the point where either it is worth its intrinsic value, its in the money amount, or it's worthless. So at expiration, it's going to be a binary event. Either your option is worth something or it's worth nothing. There is no in between. So to get from that something to nothing, to get from the at the money to an in the money, or an out of the money to in the money, is going to accelerate significantly greater in the short run over the long run. Long-term options have very slow time decay. Short-term options have very fast, very rapid time decay. And as an option seller, that's what we're looking for. If I'm selling an option for $1, ideally that option expires worthless, and I keep that entire dollar as profit. Or just prior to expiration, maybe that option is now only worth 5 cents. It went from worth $1 down to a nickel. I could buy it back to a nickel, buy it back for a nickel, and that 95 cents, the difference between what I sold the option for and what I bought it back for, that 95 cents is going to be profit. So the difference between long-term and short-term from a time decay standpoint, long-term options have a much slower decay. Short-term options have a much more rapid time decay. And then another thing to think about, and it's something that most people don't, I would expect, are various corporate actions, earnings reports, dividends, things like that that might affect the underlying stock and therefore select the option as well. If you were looking to sell an option, 4 weeks out, you'll want to know what corporate actions are on the horizon for that stock. You'll want to know, are there any dividends? Are there earnings being released? How is that going to affect the implied volatility of the contract, for example? So all of these are going to be questions that we need to investigate in order to select that expiration date. Once we have a better grip on what it is that we're looking for and what may happen in that time frame, it gives us a better idea as to what expiration date to select for our contract. So let's look at an example of a cash secured put. And here is our data on our favorite stock, XYZ. It's currently trading $81.50, and the 52-week high is $86.50, 52-week lows 78.5. So we're roughly right in the middle currently of 81.5. We're roughly right in the middle of where the stock has been trading over the last year. Now, our objective is that we want to buy the stock, but we want to buy it for $80 or less. It's currently trading 81.5. We like it at 81.5. We would love it for $80 or less. So what are we going to do? We're going to sell the June 80 strike put at $3.90. So we're looking about 3 months out. We want to buy the stock for $80 or less. We look on our options chain. We see that 3 months out would be June, and that June put is trading for $3.90. So we sell that option, $3.90. It's a cash secured put. So we're going to sell the put. We're going to deposit. Remember, we're going to deposit the difference between the strike price and that option premium. So our option premium, we collected $3.90, which is $390 of real world money. We're going to deposit our strike price of $80 minus the $390 that we received for a total of $76.10. That $76.10 is also going to be our break-even point. And if we get assigned, that's going to be the net purchase price at which we are theoretically buying the stock. Remember, we wanted to buy the stock somewhere below 80. We are effectively going to be buying these shares for $76.10 if we get assigned. Now, that brings to mind something that I would want to point out. When it comes to options, most investors, and statistically about 72% of all option trades get closed out in the market ahead of time, meaning they never live to see expiration date. If you bought an option contract, you're going to sell it to close sometime prior to expiration without exercising the contract. If you sold the contract, you're going to likely be buying to close sometime before expiration and therefore likely not be assigned on that position. What I mean by all this, or why it's important, is that 70+% of options never live to see expiration, but the cash secured put is different. The cash secured put is actually designed for you to buy the stock. It's one of the main reasons that people do this trade. Aside from some income generation, they want to buy those shares. So the way that a cash secured put is a little bit different from your normal run-of-the-mill options contract is your intent, your goal, or your motivation is actually to buy shares. You want to get assigned. The reason I bring this up is because there's often misinformation or a misunderstanding of assignment. Most people, when it comes to selling options, look at assignment as bad. And that's not necessarily the case, certainly not with a cash secured put, because like I had explained, it's really the intent of the strategy all along. So here's our example and explanation. Again, we've got our $80 strike is signified by our red dot. We know our break even is going to be our strike price, $80 minus the premium that we received for 76.10. So here's our break even point. Anything below, shares finish anywhere below 76.10, we're going to lose money on the trade, likely be assigned. We'll have to buy stock for $80. If it's trading 70 in the market, we're going to lose money on that. Anything above our break-even point, we're going to profit up until our max of 390. This maximum reward is going to assume that the option contract expired worthless and that there was no assignment on the position. Now, one of the things that may be a bit misleading on this graph, as I mentioned here, that anything under your break-even point, you're going to lose money. And that may not necessarily be so, simply because the fact that now you are long stock for $76.10. Now that you've got that long stock position, it comes with it all of the benefits of a long stock position. Your long stock from 76.10, the next day it might go up to 78. The next day it might go up to 85. The point being is that there are ways to profit even if you get assigned on a cash secured put and the trade itself isn't a winner, the resulting stock position may be. So it's certainly up to the individual investor as to what to do with that long stock position. But the maximum profit is simply going to be realized when the position expires worthless, and that would occur typically when shares finish above the $80 level. To take a further look at this example, speaking of shares above the $80 level, well, let's see what happens when that does occur. So shares finish above $80, our put expires worthless. We keep that entire $3.90 as income, and our return, if the position expires worthless and there's no assignment, here's a formula that you might want to mention. We often get calls from investors, emails, chats, et cetera, asking how to calculate ROI, how to calculate return on investment. And here's a formula that you can use. Your income divided by the investment that you initially outlay, multiplied by your time factor. With this particular trade, we would have the income would simply be our put premium plus any interest collected. Typically in this market, it's going to be relatively zero, over our cash deposit, and that's going to be multiplied by our time factor, our days or number of years, and then the days to expiration as well. So when we put that number into the model, 390, that's going to be our put premium. 0 is going to be the interest that we collected on the trade. 76.10, this is going to be, remember, our cash deposit. That's our strike price minus the premium we received. There's 365 days in a year, and this is a 3-month trade. So we've got 90 days to expiration. When we put all of that into our calculator, we come up with roughly 21% annualized. So if we did this trade, if we sold this $80 put for $3.90, and the put expired worthless, it was a 3-month strategy, it would generate roughly a 21% return, assuming that put expired worthless. So this may be another slide that you'll want to note if you've downloaded these in that resource tab on your console. This may be another slide that you want to keep track of in terms of calculating return on investment for any particular strategy that you're involved with. Now, we also have different scenarios. What if the stock finishes below 80? Well, our primary objective is met, right? We wanted to buy those shares below 80. Because we collected $3.90, we're actually buying the stock theoretically for $76.10. If stock finishes somewhere between that $80 and our break-even point of 76.10, again, we accomplished our objective. We bought stock for less than that current market price of, actually it was 81.50 when we first did our trade. So we're buying stock almost $5 below where it was originally trading. And that's going to be an unrealized profit as long as we hold on to those shares. Once we sell those shares, the profit is going to be the difference between that 76.10 where we theoretically bought it for and whatever our selling price is. If stock finishes below our break even of 76.10, well, that's going to be a problem because now we're buying stock for more than the current market price. And as long as we hold on those stocks, hold on to those shares, we're going to have an unrealized loss, assuming that those shares stay below that 76.10. If shares rally to 77, to 80, to 85, what have you, that loss then gets turned into a profit down the road once we sell those shares. So that's a look at the strategy and what happens if stock finishes above the strike price, between the strike price and our break even, and below our break even. So those are some of the ins and outs, some of the benefits and the risks of trading cash secured puts. Let's look at another risk, the early assignment. Now, when it comes to early assignment for puts, it's not as common as it is with calls. Early assignment does happen when it comes to puts. Typically, it would occur when all time value disappears. If you've got a deep in the money put where the value of that contract, the premium on that contract is almost entirely intrinsic value and very little of it time value, then there may not be much incentive for the put holder, for the buyer of that contract, to simply hold on to that contract. They may decide to simply exercise the contract early, and the reason being is that there's no time value left. Whenever you exercise a contract, whether it's a call or a put, you are exercising for the strike price. So the difference between the strike price and the stock price, that's your intrinsic value. So when you exercise a contract, you're exercising for the intrinsic value. If there is extrinsic value along with the option, or what we commonly refer to as time premium, that time premium is lost. If I have a stock for $50 and I have a $48 call, that $48 call has $2 of intrinsic value. If that option is trading $3 in the market, that extra $1 over and above the intrinsic value is going to be the time value. If I exercise my contract early, I lose that $1. I lose that time value. And in the case of puts, when losing that time value, it might be more advantageous to a put buyer or a call buyer for that matter, rather than exercising early, to simply turn around and sell the contract back to the market. If the contract's trading $3, but I can only exercise it for $2 worth of value, well, it would make more sense logically for me to simply turn around and sell the contract back to the market to close at $3 rather than exercising for $2 and gaining that $2 in value. I'd rather have $3 in my pocket. So the only time that it makes sense to exercise puts early is when all time value, or at least the majority of the time value, disappears from the contract. It also might make sense to exercise puts early in periods of high interest rates. Remember, a put holder, when they exercise their contract, they are selling stock. And when they sell stock, they get paid to do so. They get paid the value or the strike value of that contract. If I've got a $100 put and I decide to exercise it, I'm going to be selling 100 shares of stock at $100 a share, or $10,000 comes into my trading account. If I can earn a high rate of return on that $10,000 cash, it might make more sense for me to exercise my contract and collect the higher rate of return because of high interest rates, rather than holding on to that put contract that really isn't doing much for me because it's so deep in the money. Another reason that people might exercise early is prior to an earnings release, or if a stock price sharply declines, then the value of the put is going to skyrocket. And now, now you've got more time value disappearing, and that put now becomes deeper in the money. Another note here I have is the ex-div date. It's interesting when it comes to calls. Calls are generally exercised early the day prior to the ex-dividend date. And again, for those of you that are new, the ex-dividend date is simply the date at which the, in terms of the option contract, the date at which the option no longer trades with that dividend. When a dividend is paid by a company, in order to receive that dividend, for example, as a call holder, you need to be a stockholder. So typically, call holders would exercise their contract early, the day before the ex-dividend date, in order to capture that dividend payment. For a put holder, they would rather keep that dividend for themselves, and therefore they may wait to exercise their contract until the ex-dividend date and not the day before. If they were to exercise before, they would have to deliver dividend-paying stock. And obviously that's not something that most people are willing to do. So an early exercise would occur on or after that ex-dividend date. So let's move right along, managing the short put. And this is typically the bulk of the questions that we receive here at the Investor Services Desk is position management. What should I do? And again, our answer generally goes back to, one of those two questions that every investor should ask themselves even before enacting the trade. And that question being, what do you think is going to happen with that stock? So when it comes to position management, that's the first question that you should ask also. You had a certain forecast or a certain market bias in mind when you enacted the trade. Has that forecast changed? When selling puts, remember you're neutral to moderately bullish. You're neutral in the sense that you're okay with the stock not getting to your strike price, because if you do so, then the option simply expires worthless, and that premium that you collected is yours to keep as profit. So that's where the neutrality comes into play. Bullish, the idea being, obviously, if a stock goes higher, your put is likely to remain out of the money, and again, you keep that premium that you collected. So the question is, what do you do if the stock is above the strike price when expiration is near? And simply, you can do nothing and wait for the put to expire, right? Because that's the idea. The put's going to expire worthless. You're going to keep that entire premium to yourself for 100% profit. You might consider buying back the put to exit the position. Remember, we had said that about 72% of all options expire worthless. And let me rephrase that. 72% of all options get closed out in the market. About 20% of options expire worthless, and the balance actually live to see expiration and are exercised and or assigned. Buying back the put to exit the position. This is something that professional traders often employ, and very successful traders often employ. If you sell a put for $1, and really the put versus call is irrelevant. The type of option is irrelevant. Let's say you sell an option for $1. Some investors may have a plan in place, and really, for the most part, all investors should have a plan in place. There's something that a saying that we have: plan the trade and trade the plan. And what that simply means is have parameters set for yourself as to when to get in the position, but also equally important, if not even more important, when to get out of the position. Some people have a rule of thumb when selling options that once they can capture 50% of the maximum gain, they may look to close out the position. If I sell an option for $1 and now it's trading less than 50 cents in the market, maybe I buy it back and close that position, keep that profit, and take my risk off the table. Some people might be looking for more, 75% or more, 80%. Regardless of what that is, the idea is that you want to have a plan as to when to get out of the trade. And what most professional traders will do is prior to expiration, if they can close that position out for less than they sold it, that will lock in a profit, and they're going to simply buy back that contract to close, exit the position, and take their risk off the table. One of the reasons they do that is this next point: avoid after-hours risk. Trading stops at 3 o'clock Chicago time for equity options, 3:15 typically for indexes. The reason that's important is that your risk, certainly as a put seller or a call seller for that point, your risk doesn't end at 3 o'clock. Your risk basically goes until that contract expires. And if there is after-hours market movement, whether it be an earnings announcement or some news of the company itself, maybe something happened with the CEO, maybe there's a lawsuit or a drug trial, maybe there's geopolitical events, what have you. The point being is that any of those aspects, any of those occurrences could affect the stock price. If stock closes at 100, and let's say you sold the 99 strike put, right? So the option is out of the money by $1. Stock closes at 100. You're thinking, all right, I'm $1 out of the money. I have no risk. I'm going to go ahead and let that contract simply expire worthless. Now the company comes out with earnings a few minutes after the bell. They are horrible, and stock now drops to $70. Even though your contract finished out of the money, the put holder is watching the market, watching the news, and has up until his or her trading firm's cutoff time to exercise that contract. Now, that cutoff time might be 5 minutes after the close. It might be 45 minutes after the close. There's no way of knowing. And the point being is now you're thinking you're safe with your $1 out of the money put, and turns out that come Monday morning, for example, you get assigned and you're buying shares at $99 when they're trading 70 in the marketplace. So you've got that after hours risk by having that short contract position. And as rudimentary as it sounds, one of our old friends here at OIC was fond of saying, the only way to avoid assignment is not to have an assignable position, meaning that buying to close prior to the market close will avoid any of that after hours risk. So definitely different ways to manage that short put position if expiration is approaching and stock is above your strike price, or if it's even near your strike price. But what do you do if the put actually expires out of the money? Well, that's certainly up to you. Remember, you had engaged into the trade. You decided to sell the put because you wanted to buy the stock. You wanted to buy it below the current share price. Well, if your put finishes out of the money, it likely means that the stock price never got to where you wanted it to go. And if you really wanted to own the stock, then maybe you simply buy it outright. Stock was trading 100. You sold a 96 strike put. You thought the stock was going to get down there and you could buy it on the cheap. Stock only got down to 97. Your put expires worthless. Now what can you do? Well, you can decide to buy that stock for 97, or depending on where it's trading, or you might simply decide to write another put on that same stock, maybe at a different price, depending on where those shares went, or you simply collect your premium, that's your profit, and you decide to do a similar trade or a different trade on another stock. The point being is that, as with most things options, most of the questions we get here at the Investor Services Desk, there really is no singular answer. There is no right answer, because that many of the scenarios apply differently to different investors. Just as no two investors are the same, no two motivations, forecasts, scenarios, et cetera, are the same for everybody. There's no one size fits all. So definitely, something to think about. It's an individual decision that you're going to have to make, and certainly contacting your broker and discussing it with them, or shooting us a note here at OIC. We'd be happy to talk to you about how to manage these contracts as well. Now, what do we do if the stock finishes below, or the stock looks like it's going to finish below our stock price? So if the stock begins to decline sharply, we can roll it to another put. And what we mean by rolling is simply closing out the existing trade and enacting another one. So we might, close out our 96 strike put, and maybe we sell a 90 strike put. This is assuming that the shares declined, well below our strike price. Maybe we decide to hold on to that short put position and see what happens. Or we can buy that short put back at a loss. As the stock price declines, the value of the put is going to increase. So if we sold it at $1 when stock was trading, say, 100, with stock now trading, say, $90 or so, that put might be trading $10. So, we would have a significant loss. But maybe we simply buy that put back and then sell another one at a lower price. Or what we might simply do is use a stop loss orders to protect against those declines in the underlying. The idea being is we want some protection should things go south on us. So what do we do if our put expires in the money? Well, this is where things get tricky, because likely we're going to get assigned. So that cash that we had initially deposited in the account to provide margin for that cash secured put, that cash is now going to be debited from our account. Now we're going to be long 100 shares of stock. This is my favorite part, though. And the reason I say that is because we often talk to investors, many of which are retirees, that love cash secured puts and covered calls. So let's think about this scenario. You sold a cash secured put, you put the cash up in case of assignment. Now you're assigned, and you are now a stockholder. You now have 100 shares of stock. So what do we do with that 100 shares? Well, now we've got the potential to sell covered calls against those 100 shares and generate additional income. If the covered calls expire worthless, we just keep selling another call, generating additional income that way. If we get assigned on our covered call, now we sell those shares, we're long cash, and we simply rinse and repeat. With that cash, we do another cash secured put. If we get assigned, we have long stock. Now we sell a covered call against it, and we do it again and again and again. And with luck, we'll generate some pretty nice and consistent returns. So the cash secured put and the covered call as alternate strategies is definitely a favorite of income-seeking investors. And again, one of the great things I love about the strategy. So remember, our intent is to buy the dip, but what if it doesn't dip? That's going to be a risk, because it's a missed opportunity to get long the stock. We liked the stock at 100. We thought we would love it at 96. Now it's trading 105. So we've missed that opportunity. We're certainly not going to be able to buy it at 96. We can no longer buy it for 100. We missed that opportunity to get long stock. Maybe that's okay with us. Or maybe we decide that we're going to pay we are going to get the long stock, and we're going to end up paying more than we originally wanted to. Or maybe we just realize that, okay, this one didn't work out. As my wife likes to tell me when it comes to my jokes, they can't all be winners. And similar to our trades, obviously we're not going to be successful on every trade. Another risk of our cash secured puts, again, it's this post-closing market moves that I was talking about. And I can't stress this enough because we often hear from investors saying, my contract expired out of the money and yet I got assigned. Or another situation, for example, I had a gentleman that had a put spread on a very volatile stock, and the legs expired out of the money, ended up getting assigned on one of the short puts and was forced to buy shares significantly higher than where the market opened on Monday. And his complaint was that he was always told that one of the great things about spread trading is that you have defined risk. And while you do have defined risk while you're in the trade, once the trade is over and assignment or exercise occurs, that defined risk no longer exists. In his case, he had a put spread on, and he thought his maximum risk on it was going to be about $10,000. Ended up getting assigned on short puts and buying several thousand shares of a highly volatile stock that opened up at a significant decline on Monday, and his risk ended up being about 8 times what he was expecting it to be. So, and all that leads back to what we were talking about earlier, that these post-market moves can significantly impact your trade. With a short put, for example, you've got the potential to be long stock on a plummeting asset. So therefore, many professional traders look to buy to close. That's BTC, buy to close. It's not Bitcoin, to avoid that pin risk. And pin risk is simply, it's really the risk that a short option writer has when the stock price is very close to their strike price, and they don't really know whether or not they're going to get assigned. So there's that risk that the strike gets pinned by the stock. And the easiest way to avoid this is to simply close out the position ahead of time. You can always, assuming the stock isn't halted, you can always buy an option. You can't always sell an option because there needs to be a buyer for it, but there will always be a seller for an option if you're looking to buy. So you can buy back, even if it's a worthless contract, you can buy it back for a penny or two, or maybe even a nickel or a dime, that last day of trading, or maybe the day before. But what it does is those few pennies buy you peace of mind. They ensure that you're not going to get assigned when selling options. Because once you buy to close, you no longer have an assignable position. One of the phrases that we have on the floor that we use a lot is, when in doubt, close them out. If you're not sure if you're going to get assigned, and if assignment is not welcome, then certainly close out that contract. So that is it for our cash secured puts. We're going to take Q&A in just a moment. Here's some contact information for you. Our website, optionseducation.org. As I mentioned, we are very proud to have just launched a new online course, Option Pricing Explained, where we talk about all the different facets and aspects of option pricing, including how prices are affected by supply and demand. We talk about different pricing formulas or pricing models, like the Black-Scholes model, binomial pricing models, etc. We also talk about the options concept of put-call parity and how you can tell basically what put-call parity is how you can tell whether or not an option is fairly priced. And then lastly, the last module on that is Introduction to the Greeks, where we do a high-level overview of the Greeks and then a quiz to sum up the course to test your knowledge. So optionseducation.org is where those courses live. You can also contact our investor education team at options@theocc.com, or feel free to live chat with us. Also, social media, we're on YouTube, Facebook, Twitter, etc. So definitely make sure that you follow us to keep abreast of any